In this video, we're going to be talking about the 2% rent rule for buying rental property. So my name is Nick Foy, the founder of Under30Wealth.com. This is my website, Under30Wealth, where we teach real estate investing. So you can learn about my course here. You can also join my email mini course. You can learn how to get more leads for your real estate investing business. And then we've got different resources like YouTube, a blog, and a podcast you can check out. So hop over here to Under30Wealth.com after watching today's video. It'll be linked below in the description. Now today we're talking about the 2% rule for buying rental property. It's a quick rule of thumb basically that's just a screening tool to help you analyze through a bunch of different deals in one night so that you can determine what deals look underpriced, which deals look overpriced, etc. So basically what the 2% rule does in a nutshell is it analyzes the rent relative to the asking price. And you want the rents to be about 2% of the asking price. If the percentage is less, then you're probably paying a higher premium for those rents. So that means that the property's probably in a better location where property values are going to go up higher longer term. So the property might not cash flow as well, but you might get some added benefit of property value appreciation. However, if you're buying strictly for cash flow, meaning the money coming in minus the money going out for expenses, whatever's left is your property's net income. It's your cash flow that you're taking home to your bank. If you're passive income investing, you're going to hire a property manager and you're going to try to live off the rental income you're earning. Then you're going to want to care more about the 2% rate because you're going to want to look for properties that are priced cheap enough that you're basically buying rental cash flow streams at a cheap price. You don't want to pay a higher premium for them where the return is lower, than that 2%. So let's go ahead and put some math to it now that I kind of explained it. So I give an example down here in the article you can check out. Again, this will be linked below. But my very first deal I bought when I was 20. So here we are with this highlighted text here so you can follow along. So when I bought my first rental property at age 20, the landlord was only charging the tenant $450 a month, which was pretty insane. This was a 3-bedroom house. The 3-bedroom rents were easily $800, $900. Some were getting $1,000 a month for 3 bedrooms. Now this is in the Midwest, so this is in a cheaper rental market. I know if you go out to Los Angeles or a big city, a 3-bedroom is going to run you $3,000 a month, whereas in the Midwest, a 3-bed could maybe get you $900 to $1,000 a month. So it's still cheaper rents than a big city, but he was only charging $450. So the point is rents were cheap. So we knew right away we could come in, buy this property, kick that tenant out, or raise rents. If they didn't want to pay, then we got to boot them out. We got to get a new tenant in that's willing to pay market rent. So that was the goal, to get this thing cash flowing. And because it was only rented at $450 a month, the landlord was only asking, I think, like $30,000 for the property. So we got the property for $30,000, which is pretty crazy considering the 2% rule. So if we analyze with the 2% rule, and let's say we think we can get $900 a month for the property in rent. So $900 a month in rents, we're going to divide that by 2% to figure out what our max purchase price is. So $900 is 2% of $45,000. Now, if your rents were $1,000, then 2% would be $50,000. If it was $2,000 in rents a month, $2,000 would be 2% of $100,000. So if you just do some simple math there, $2,000 divided by $100,000, that's 2%. So now we're down about half of that. So we're down here at $900. So you'd split that $100,000 in half and you get roughly about $45,000. So you could use a calculator to figure it out, but $900 is 2% of $45,000. So that gives us a quick calculation of what we think fair value for this property would be if we're trying to abide by the 2% rule. And now we were able to get the deal for $30,000, but it did need renovations. So we had to factor that in as well. So all said and done, we spent about $15,000 on the property on the rehab budget. So we were all in for that $45,000. So we met the 2% rule pretty much dead on. We were getting $900 a month in rents. Or I think $925 is what we ended up collecting in rent, so a little bit more than $900, but we ended up sinking about $45,000 in the property. So we were collecting, 2% rent of what we were all in for the purchase price and rehab and stuff. So that ended up working out. Now, a few things to note: if you're buying again in a big market like Los Angeles, you're going to see different properties in Los Angeles maybe renting for, maybe double this. So instead of $900 a month rent in Los Angeles, you're going to see properties going for $1,800 a month. So if we're going to find out what is 2%, $1,800, we would just double this. So $1,800 a month is 2% of $90,000. So you're not going to find a property in Los Angeles selling for $90,000. It's just not going to happen. So that's what I'm saying about the 2% rule. It doesn't work out in big cities where they're more focused on rental property price appreciation, meaning the property values go up each year. So property values this year, might be 300, 400, 500,000, and then next year they go up another 10, 15%, and they just grow at a rapid pace like that, where the property values are doubling every 3, 4, 5 years. That's what they're investing for in those big cities. But if you're going to invest for cash flow, meaning the property value of this home, maybe we bought it for 45 all in, and it might be worth 50, 60 grand if we were going to sell it, just as a rough example. And we know maybe long term that maybe 10 years from now, this $50,000, $60,000 property is probably still only going to be worth 55, 65, maybe 70,000 at that point. So it's not going to appreciate in value that much. We're more concerned about reaping in, tons of cash flow, making a return on our investment of $45,000 at a high rate of return from the cash flow side of things. So that's where this 2% rule applies. So again, just want to make that clear. So if you're in a big city market and you're like, this 2% rule is not going to work, you're absolutely correct. In that market, your guys' rent rule might be like a 1% or 0.75%. It might not even be close to 2%. But if you're investing for cash flow, then you're probably going to want to look in like a Midwest market like Michigan, Ohio, Kentucky, around those Rust Belt states where you're going to find property values are still $50,000, $60,000, $70,000, yet rents are, $800, $900, $1,000 a month. Then you're going to be able to get a good rental return on your investment. So that's pretty much to sum up what the 2% rule is that you're going to learn about in this article. If you head over to the website to check it out, we just broke down pretty much how the 2% rule is calculated. You're just literally looking at what the asking price is and then multiply that by 2% to see what the rents would be. And if the rents are way higher than what you think you can get, then that tells you that the property is probably overpriced. So first, what you want to do is basically determine what you think you could rent the property for, then divide that rental amount by 2%, and that's going to give you a rough purchase price that you want to aim for. And then you can compare that to what the neighborhood prices are to see if the for sale price is overvalued or not. And if you find one that fits the 2% rule, it could be a go. Now, before we close off this video, I want to make sure you understand a few problems with the 2% rule. So if you find deals that do meet the 2% rule, it's typically because they are in bad locations. So just be wary of that. You might find one that meets the 2% rule, but it's also in a bad part of town that's got a high crime rate. People are breaking into properties, graffitiing properties, murders happening down the road. Some crazy stuff like that could be going on around that property, and that's going to hurt the value of that property long term. Like we talked about earlier, a lot of times the ones that meet the 2% rule are because they're cash cows. They put out lots of cash flow, but they don't necessarily have the best potential long term for property values going up. So think about the location you're buying in. Ideally target decent neighborhoods where property values are going up in value, and you're also able to find one that meets the 2% rule. That's kind of the unicorn dream scenario, and that's what we happened to find in our first deal. Buying that $45,000 property for 30 grand, putting 15 into it, all in for 45, ended up selling it a couple years later for 120,000, as that's what the neighborhood prices were going for. So it was a pretty sweet deal. We got on the equity side of it. We made a bunch when we sold it, when we flipped it. But in the meantime, we bought it at such a cheap price that it fit the 2% rule, and we rolled in a bunch of cash flow off that property as well, because we didn't have a fat mortgage payment, because we didn't overpay for the property. We got it at such a cheap price that we were able to pay all cash, have no debt on the property, and not have to worry about a mortgage payment eating into the cash flow. So that's one of the reasons why we use the 2% rule. It's to determine a low price that we could try to buy it at, because the lower you can buy the property, the more money you're going to make, the less money you're going to spend out on a mortgage payment, and you're going to earn more cash flow, which means more return on investment. So thanks for watching this video. I hope a lot of that made sense. If you're brand new, I'd advise reading the article. It should be a lot clearer after you get through both this video and the article. Again, my name is Nick Foy, the founder of AskNickFoy.teachable.com, my real estate investing school where you can learn how to invest in real estate and earn six figures. Again, one of my first flips basically earned us six figures because of what we bought it for, what we sold it for, what we earned off rental income over a couple years. And then the way we sold it, we ended up earning more money than what we sold the property for. Doing some seller financing on the deal, earning some extra interest on the loan payments. So it was a pretty sweet deal, earning six figures on my very first deal that I bought when I was 20 years old. And I've since then acquired more properties. I had a 3-unit I added. I had a 5-unit under contract. So I've continued expanding my real estate portfolio, and I share everything I've learned along the way inside of this course that is 16 chapters. And you can see all the different modules covered in each chapter if you come over here to AskNickFoy.teachable.com. So I'll link to that below in the YouTube video. Again, thanks for watching. Thanks for giving me your time. Subscribe to the channel if you're new here, and I'll see you guys in the next real estate investing video.